Welcome to another episode of Quest for Twice. Today is March 22nd. So I'm going to cover updates from two companies today. One is Method Electronics, the other one is INMD. But first, let me talk about what happened in March. So it was in the headline news that SVB and two other banks closed in the US. It caused a banking crisis in terms of depositors losing confidence in mid-sized banks. However, if we look at the stock market performance, this chart, the black bars shows the S&P 500 price performance in this year. So in March, the market as a whole actually is little changed as of today from the beginning of the month. And if we look closely at the two sectors of S&P 500, that is the financial sector XLF and the energy sector XLE, we can see that in March both sectors were hammered in terms of their ETF price performance. It is understandable to see the XLF got hammered because that represents the financial sector. But why has the energy sector got severely punished? The explanation is the market is anticipating a recession caused by the banking crisis. As a result, the financial sector and the energy sector had a very similar stock price performance in March. It remains to be seen if a recession is going to be accelerated by the banking crisis. I don't have the ability to make that prediction, so I'll just keep monitoring the situation. Method Electronics reported the quarterly earnings and wrapped up the fiscal 2023. For the full year, its 2023 revenue declined slightly from 1 year ago. That's due to foreign exchange rate headwind and less premium by pass-through. What is concerning is its gross margin is still low, slightly above 23% for the full year. So it is declining starting in 2020. But there is very little sign of margin recovery if we look at the quarterly gross margin. That's shown in the bar chart at the bottom right. The margin compression is due to the cost and the labor inflation, and also indicating Method doesn't have a lot of pricing power to pass through the higher cost to its customers. The management gave a downbeat outlook with next year's sales flat, but reiterated its sales target in 2025, and that's implying about a 20% sales jump from fiscal year 2024 to fiscal year 2025. At $43 per share, its forward PE is about 17, and its EV over EBITDA is about 10, using in this year's EBITDA about $164 million. Because now I doubt its moat due to its inability to defend its margin. So I don't think the PE or EV over EBITDA ratios suggest it's undervalued. I just have to keep on watching the stock. If it has a significant price decline from here, then it may present an attractive entry point. Now let's switch gear to look at the INMD. This is a medical aesthetic equipment supplier. Its equipment is used for skin tightening, collagen generation, and fat reduction. So basically, it can make people appear more attractive. Its main products are based on bipolar radio frequency technology, with 12% of its revenue from consumables and services, and 1/3 of its revenue from international market. We can see from the chart on the right, its revenue experienced very fast growth in the last 6 years, with a CAGR about 40%. It's also remarkable that it has a very high gross margin, around 85%. I calculated its return on invested capital before tax is about 70 to 100%, which is extremely high. So the stock is definitely interesting, and the question is, can the faster growth continue? To answer this question, we really need to answer the underlying question, which is why is strong competition absent from such a profitable business? Remember, the business has a very high gross margin and a very high return on invested capital. Normally, that would attract investments from competitors, and that will erode its margin and return on invested capital. So I believe INMD enjoys a narrow moat from intellectual properties. One is its bipolar radio frequency technology is a better one than monopolar radio frequency. And its technology enjoys patent protections. With some search, I found a few key patents. One covers the bipolar RF technology, which will expire in about 12 years. Another one is related to combining RF energy with liposuction. Expires in 15 years. The third one is covering the Morpheus 8 technology and set to expire in 15 years. So it has quite a bit of a runway for it to be protected by its patent and continue its growth. The international market, I believe, is a really strong growth opportunity. Despite about 6,600 units installed in the US, compared to 14,000 units worldwide, the US still contributes 64% of INMD's revenue. Now, let's look at its valuation and risks. Its PE is less than 16, and the EV over EBIT is about 10 at $31 per share. As I mentioned earlier, it enjoys very fast revenue growth and steadily high gross margin over 80%. So the opportunity is the large international markets for it to penetrate, and the threat is a lack of visibility of a total addressable market of United States. Another opportunity is its R&D efforts have been generating new products targeting medical therapeutic service, including women's health. I also want to point out that I believe the medical aesthetic service should be resilient during stagflation scenario, because for many people, looking good is a high priority, and they will spend money in a stagflation environment. The threat is Medical aesthetic service may be considered discretionary during a recession. So if a severe recession hits, then INMD's revenue may take a hit. So overall conclusion is that this is a growth stock priced like a value one. So I believe its current price presents an attractive entry point. This concludes this episode of Quest for Twice. Until next time, happy investing.